everybody. My name is Graeme Allan. I am the Regional Wealth Leader for the eastern half of Canada, and in conjunction with my colleague Alex Chan. We are really happy to bring another session for you all today. This is something that maybe you haven't looked at as part of your regular day. I mean, there's a couple of providers of income product out there that are kind of prevalent in the marketplace. And this one may well have been overlooked as part of that or your regular due diligence. So it's with pleasure I introduce the team from IA, Angelina and Fraser, on the line today to cover this and obviously anything else that may well be along the lines on the IA product shelf. I think if we're looking for a one-stop shop for building your practice, IA really has the complete shelf. I mean, from RESPs right through regular registered, non-registered products and into the QROPs or pension transfers from the UK, they really have it all. And today's focus is obviously going to be on a guaranteed monthly income product. And with that in mind, I'd really like to keep the focus on that. So it's very easy in these kind of conversations to start comparing to other types of products, like annuities or maybe cash wedge strategies with seg funds, but that's not really the focus today. We want to really look at this product as something that you can look at your product shelf for client use. We're in an environment where clients are looking for guaranteed income more than ever with interest rates changing and market volatility. This is prevalent to your clients' minds. They're emotional, and are they going to have enough money in retirement is really what the question is. They're not talking about costs or performance. They need to be assured that what they're going to have as far as their pension income goes is going to be there, and it's going to be there for the length of time that they are in retirement. So that's the concern I want to address. I'm going to hand things over to Angelina in her capable hands for the next 45 minutes or so. Maybe we can keep some questions for the end, but as I said, focus. Let's get the most out of this session as we can, and the first and hopefully a few to come. So over to you, Angelina.
Thanks very much, Graeme, for that intro. And just to take a second to introduce myself, my name is Angelina Basra. I'm the sales director here for IDC, but only in Ontario. So if you like the presentation and wanted more information in your region, flip an email to either Graeme or Alex, and they will get you in touch with your wholesaler. But again, thanks, Graeme, for the opportunity, and IDC at large for allowing us to present today. The topic of today is going to be our FORLIFE product. This is something that you've probably never heard me speak about. Given previous economic conditions, there wasn't really a need. But I think today, more than ever, as Graeme mentioned, there is a need for reliable income regardless of market conditions. So to top off today's agenda, I'm going to discuss the backdrop. So why higher interest rates benefit insurance companies. I'm also going to touch on our FORLIFE series and how it could bring stability to your clients' portfolios and retirement income strategies. I will have case studies as well. And then finally, I will touch on the differences between our other products, so our seg funds here at IA. Over the course of, since 1892, the last 130 years, IA has been up to quite a bit. So you might not see us heavily marketing our brand, but you can see in this time series in front of you that we have tenure in Canada. So we are, predominantly in Canada. We've recently moved into the US as of 2018. But since demutualizing in Y2K, you can see the growth that we've presented over to our shareholders depicted in our stock price. But really, the point of this slide for today's purposes is going to just, talk about why the current interest rate environment is actually fantastic for insurance companies. So insurance companies thrive because they're scooping up long-term government bonds to back liabilities that they have in the, in insurance, whole life policies and UL policies, as well as investments like annuities, GMWBs, and GICs. So obviously, all these products are very rate driven, but, this is the time to be harping on why you want to do business with insurance companies versus the banks. And, our long track history of being around for 130 years you should have, IA in your portfolio of a company to go to, if not first, at least second or third. So just to touch on our stock price, as I mentioned earlier, looking at August 24th, our stock was somewhere around about $73 a share. I remember February of this year was at $83 a share. This morning, I just looked at it, it's about $69 a share. So pretty solid for a mid-cap financial services company traded on the Toronto Stock Exchange. We've seen huge growth and price appreciation. And as well, I wanted to point out, having worked at RBC previously before IA, I know everyone loves that dividend at 4.13, but IA's dividend actually increased in February by 30%. So our dividend currently is hovering around 3.86%. So not too shabby for a mid-cap financial services company traded on the Toronto Stock Exchange. Again, if your clients are not well versed with IA, I think this, as well as the previous slide, really show all that needs to be told with IA. We have a major growth story that's over 100 years old, 130 years old now. And more than ever, now is the time to consider doing business with insurance companies as opposed to my previous post at the bank. And I'm really going to delve into this product here and, how it compares to other funds out there and other investment solutions. But really, as Graeme mentioned earlier, it's a standalone product. As you know, that there are government programs for retirement. So we have the QPP in Quebec, the OAS and GIS and CPP. Then we have employer pension plans, right? The ones that we're all well aware of are DC, defined contribution or defined benefit plan. We have DPSPs, group RRSPs. Some people have RESOPs, group TFSAs, and non-registered plans that are set up with potentially company stock. Then we have, this is the world that you and I dabble in, our personal savings. So we have RRSPs, TFSAs, non-registered, and emergency funds. And then this part is we have our cash, quote unquote, cash or rate-driven products, such as T-Series mutual funds, FORLIFE Series, this product today that I'm going to talk about, and annuities and GICs and other fixed income products. So that is the full picture of the products that are available to your clients. And in preparation for today's presentation, I looked at a book that I'm sure most of you advisors are aware of, but it's called Pensionize Your Nest Egg. So how to use product allocation to create a guaranteed income for life. And this was published in April 2015 by two advisors, Moshe Malevsky and Alexandra McQueen. So the gist of this book really is in terms of product allocation, and it is older, so it is in 2015. So times are a bit different, but the theory still applies. You want to dedicate a portion of your nest egg towards guaranteeing income. So if you're thinking about retirement, there needs to be at least 25 or 40% based on their studies. On average, that should be dedicated towards an income guaranteed product. So this is looking at the total investment. So once you've done that deep dive in financial planning, whether you're using NaviPlan or Razor Plan, once you know all those figures, the benchmark based on the studies of this book shows that about 25 to 40% on average should be dedicated to an income solution. Now let's talk about these percentages, right? So you and I both, I was studying during the time you advisors on the call that you were probably getting into the business, but you will remember in theory or any exams that you're writing that there is this, 3.5% rate of return that's required, or 5% rate of return that's required each year consistently to get your clients to a comfortable place to be able to retire by, say, 70 or 65. We know that's not a reality today. So just to put some meat on that point that I brought up, so a safe withdrawal rate for a 90% success rate, then I have a 95% success rate, then a 99% success rate here, is if you're looking to retire in a 25-year time horizon or have retirement money for that 25-year period, you're looking at a 3.5% rate of return annually on a balanced portfolio. This data needs to be revisited. What is 3.5% on $500,000, for example? It's $17,500 annually, and that's less than $1,500 per month. 3.5% does not mean much today, and I'm definitely not going to bring up the inflation word, but that is pretty evident in today's figures that we're needing more than a 5% rate of return at least, in the portfolio. But more than that, what product do you have guarantees of 5% rate of return? And this is why I'm going to talk to you about FORLIFE. So when your clients are retiring, you advisors know that the conversation of liquidity risk comes up, right? What if something happens? Thankfully, we're not in the US. We do have healthcare here in Canada. So, big health events won't necessarily be a liquidity risk for your client. But what if there is a liquidity risk, for example, in their life, or a longevity risk? What if they outlive their investments? I know both my grandparents have longevity. My grandmother is 102. And it's so funny because, now knowing that she's lived to that long, I remember, back 30 years ago when I was younger, my parents would say, our retirement plans are you guys, you and my 3 siblings. So, longevity risk, it is a true factor. If you don't have the family here to help you out, you do have to make your money work for you. Inflation risk. And then I'm going to talk about, I don't like to talk about inflation. That can tend to spiral the conversation. So we'll keep that word out of the vocabulary for today. But I am going to talk about rate of return risk. In other words, what I'm going to call sequence of returns. So the importance of understanding the sequence of returns. That is the purpose of today's presentation. So now let's look at the sequence of return. You have 2 sequences here, sequence 1 and sequence 2. We have just a straight situation where you have $100,000, no additional deposits or withdrawals, you just let it sit. Sequence 1, in year 1, you have a plus year. The first year that sequence 2 is being invested, it is a negative year. The market is down 5%. Of course, year 2, 3, 4, 5, it's identical. Rates of return, the money's in the markets. So sequence 1 and 2 are getting identical markets. The value at the end of the portfolio date, so after the 5 years, is identical. It doesn't matter what your sequence, whether your sequence 1 or sequence 2, if it was positive or negative in the first year, in identical markets, moving forward in the same investment, you're going to have the same end value. Now let's talk about, which I highlighted there in an animation. Now let's talk about what happens when you factor in a withdrawal. So say your client needs to withdraw annually $10,000. Well, let's have a look at sequence 1. Again, same market conditions as the previous slide. Sequence 1, you're looking at that client got in when the market was positive 5%. Well, their end value with that $10,000 annual withdrawal is $62,980. Now let's look at what happened when the client who needed to take money out, but the market was down 5% that year. Well, they're impacted, but their end value is $58,669, and at the end they're actually short $4,311. So the sequence of returns with withdrawals really matter, and this scenario, these 2 slides depict that. It's a traditional scenario that, people currently with seg funds, mutual funds, ETF index funds are probably seeing, this exact scenario right now. And that is really why you should have a cash wedge strategy or, a GMWB product, which I'm going to mention a little later in, case studies. But really, the only difference between sequence 1 and sequence 2 is that at the beginning of the year, one was positive and the other was negative. But what do we know with the markets? You got to take more risk to get out of that -5 scenario. So sequence 2, let's map it out. If they were invested in seg funds or mutual funds, ETFs, index, whatever financial services product out there that is invested in equities, they need to take outsized risk, to get out of that position. And some people in their retirement age or in that age bracket are not comfortable taking that risk. So, this could have been avoided with a cash wedge product like the FORLIFE. Let's kind of expand on the topic of what are the impacts of losses on returns and the asymmetry of gains and losses. So just to put this pyramid in front of you, there's a lot of numbers here, but focus on the one I circled. So if you have a cumulative rate of return of 60% in your portfolio, so say it's been invested for 10 years, or even in 1 year, it's had 60% rate of return. I just wanted to make it kind of realistic. Say in the last 10 years, your portfolio has gone up by 60%. That's amazing. All you need is 1 year of negative 38%. So the market needs to drop as it did in March 18th the market needs to drop to a total bottom of 38% to wipe out 10 years of that return. So that really talks to you about how, volatile the markets could be, but unfortunately a 60% return doesn't mean you need to decrease 60%. It is only 38%. This is, just, math. But the point is, let's look at today's value, a 30% gain, which I know many clients were happy with last year, a 23% loss, which is where we currently are right now in the markets. That is what it takes to wipe out last year. So this obviously, hindsight is 2020, but we didn't know this was going to happen last year, but we can avoid this. So people, currently in their 40s and their 50s today can avoid this scenario happening in the future by investing in a guaranteed income product. So let's talk about now how many years it requires to recover from this type of loss. So assuming today's value, so we know we're down about 30% if you're in equities, US equities, global equities, you're down about 30%. And this, by the way, has been a rocky week or even month, rather, for the stock market. So great time to be talking about this product with your clients. But say you're down 30%, it will take you 18 years if you purchase a 2% GIC today to recover. Some of your clients may not have that time. Now, it could take you 12 years to recover at a 3% guaranteed product. I know with our product, we can guarantee 5%. So it'll take you 7.3 years to recover. And this could be a topic that you have with your clients today. Do we have 7 years before we need income? Is this a product that you can consider in your portfolio? And I think this is a very reasonable proposition. And we're not selling you something that's too good to be true. We're just educating you on your options. I'm not saying, again, to put 100% of your portfolio into this, but we know the study by Moshe Milevsky at the beginning that I cited shows that at least 24 to 40% of your income should be invested at least in an income product. So now to pivot a little bit into what the FORLIFE series is and what it can do for your clients to help bring stability into their income portfolio or give them their income that they need. So FORLIFE is it's a niche product here at IEA. You'll mostly know IEA for their 75, 75, and 75 100 product lineups, but we do have a 100 100 product as well here at IEA. We call it the Eco Flex. I'm happy to talk to you about that one or connect you with your wholesaler offline if you have more questions about our 100 100 product. But with the FORLIFE series, we have two stages: the saving stage and the income stage. The saving stage, in short, requires you to be invested for 10 years prior to electing the income stage. So for the purposes of today's presentation, we don't have that 10-year time horizon. So we're only going to focus on the income stage part of the FORLIFE product, but really could be blended into two. Actually, I prefer investing in traditional seg funds. So our 75-75, whether it's Fidelity, PIMCO, Dynamic, sort of wrapped funds. And then, of course, we have the IAIM funds that everyone knows I'm a big proponent of as well. I prefer that and then converting into the income stage because, of course, you're going to get really good returns, with those track histories of our funds. So this is a good moment to just have a look at our income stage, not our saving stage. Because I truly, to be quite honest, I think our saving stage fund options are not as strong as the fund options that we have in our regular seg funds, but you can still get the benefit of income very easily by combining it. So we've changed, so we've segmented our product into two stages, which you can take advantage of. You don't need to be only in the income stage first. Versus other companies that do require that sequence of investing in one side first and then getting electing income. So what are some advantages of the FORLIFE? I highlighted the important words here. So it's guaranteed. It is a risk-free investment. Guaranteed payments could increase along with interest rates if they do increase. That's in a deferred scenario. Access to investment funds at any time. This is not an annuity. You can access your funds anytime. Estate protection. I know with some of our competitors, they offer the 75% death benefit, but with IEA, it is 100% death benefit on any deposits before age 80. And then, of course, the concept that I'm going to present later, which is the RIF withdrawal concept. So creating an everlasting RIF withdrawal scenario for your client with our FORLIFE product. So now let's talk about the features of our product. We have a minimum deposit of $25,000, an additional deposit of $100 that could either be in packs or ad hoc payment. And the minimum age to be invested in this product has to be age 50, unless you're in the saving stage, where it could be younger than age 50, because we need that 10 years of vesting. So you could be younger than age 50 if you're looking for the saving stage, but you have to be a minimum of 50 if you're looking at the income stage. And then, of course, it is a liquid investment. You can pull out of this investment anytime. It can give you guaranteed security for a moment in time, and then, of course, you can access the funds anytime. So now, regarding the income stage at age 50, I wanted to mention, I kind of pointed out earlier that we have two funds to be invested in the income stage. Both of them are great funds. The one that we're going to focus on today is going to be the 100% fixed income fund, because this is obviously prescient in everyone's minds right now with the bond market. Potentially longer term duration is coming into vogue now, and we should get rid of the short term. So it could be a good opportunity for long-term bonds. So government bonds are what we're going to focus on. Of course, we have that equity component too. So if you want that flexibility of growth, and it comes with greater volatility, of course, you are going to get that. We do have an option here for 30% equity there. And then I'd mentioned our same series. We have a slew of funds that you can choose from in our savings series. So today we're going to focus on the guaranteed maximum income fund, which is 100% bond fund. So I mentioned that it is a bond fund. So just by looking at the index currently today, so the Canadian bond index right now, the ETF is showing a loss of 11%. So very similar to this bond, but I would say that it's kind of a core plus strategy. So what do I mean by that? A core strategy is investment grade bonds, so government, provincial, some municipal, and then which has a rating of AAA, AA, and single A. And then the plus stands for a little bit riskier bond options. So corporate issues, for example, floating rate, for example, and some mortgage-backed securities and asset-backed security options. So the average rating for this fund at IA is BBB. So it is still a investment grade fund, but just wanted to position it as more of a core plus strategy rather than, a Canadian bond, which is, full of government issues, for example. But I'd mentioned earlier, now is a great time to get into government bonds because insurance companies, first and foremost, need to cover the liabilities. So they're buying these 30-year, 20-year long-term bonds. This is a topic. This is a question I usually get with all the advisors. So anytime someone asks me, tell me about your FORLIFE product, it's always, okay, these products are complicated. So, what's the gist of this product? So I think this slide is super important. Obviously the details on the product is important as well, but this slide is really important, and it really shows how easy this product is to grasp. All it is our investment. So what is the deposit that your client has times the current income rate? And by the way, for those of you not familiar with what the current income rate, it's just a blend of mortality credits and statistics that actuaries use to pool together a rate of that's assigned to a date of birth and a gender that says, based on this rate, this is what we're going to pay you. And this is actually proprietary to the company. So it really depends. The current income rate at IA, at RBC, at Empire, at Sun Life will be very different. So, that is our current income rate. And again, it's the same kind of actuarial table that's required in calculating annuity returns, for example. Very, very simple. You're getting the deposit, what the current income rate is right now at IA on the website. That's based on date of birth. That will get you your payment for life. You actually don't even need to think about what is the investment that you're invested in, right? And that's the selling point for this other fund that we have, because we have 30% of it in equities. You don't have to think about, what's the underlying investment, because you don't need to worry about that internal rate of return, because you're guaranteeing your client this. It's the income rate that you're guaranteeing your client that equals that payment for life. So I think as a selling point, this product is very, very easy to sell. Once you grasp the features and the advantages to selling this product, now more than ever in a rising interest rate environment, I can just go back just to go on a tangent for a minute here. I can go back to, 2018 when certain companies were paying advisors to get rid of GMWB products because in a low interest rate environment, it was not beneficial for the insurance companies to have these products. Then we look at, last year, for example, whole life policies at big established insurance companies in Canada were having to revisit the dividend that was guaranteed because it's so hard to give you a dividend in a low interest rate environment. So today, when we have higher interest rate environments, insurance companies thrive for whole life products, which, by the way, we launched at the lowest point of the interest rates. IA was smart and we launched it. Why? Because if we're purchasing bonds today, we can guarantee that, 5.75% dividend that our whole life product guarantees, because we're getting in at such a good time when everything was in, basically at a discount. So I have to say that, kudos to our life division for thinking of launching a whole life product in a pandemic. I think it is such a smart move here. But just to go back for a sec, when insurance companies are getting rid of products, that's, you should question why that is. And, maybe this product is too good to continue, right? And just to caveat that with IA, we have a maximum for a deposit in this FORLIFE product, and that's $20 million per client. And the reason for that is if you have a $20 million client, that's going to throw off our tables. That risk might impact another client that we have in the product because it is a pool, it is kind of a pooled product, and it could throw things off. So we do have a $20 million. I know Graeme actually called me about this last year and said, hey, I have a $20 million case. Is this something that I can entertain? And I let them know that that is the upward limit of our deposits here in this product. So again, the current income rates, as I mentioned previously, are based on date of birth and sex, and it is reviewed weekly. So this is different than our competitors. Some of them review it quarterly, some of them review it monthly. Graeme would probably know the details of that, but we review it weekly. So our income table does update weekly. As a wholesaler, it's hard for me to keep my presentation relevant because of all these updates, especially all these monthly increases, but we do publish that on the website. So you can find that on the website in the FORLIFE tab. So here we have what our current income rates are as of June 10th, 2022. They've obviously moved up quite a bit, but it's tough for me to rejig this presentation. So so for male, we have on the left side, for female, we have on the right side. As you can see, the higher, the older the male client and the female client, the higher the current income rate is, right? But as you can see, at a certain point, it's actually beneficial. It's actually mostly beneficial for males. And that has to do with mortality credits. But so the point is, this table here is available on the website. All you have to do is calculate the deposit times the income rate, which is dependent on the age and the gender, and that will spit out what your guaranteed income for life is. Okay, so, and then of course it's up to you to choose whether you want the bond fund or the equity fund, but I do think that there is a selling point for bonds today. So here's a simple example. We have a slide right in front of you. 200K is the deposit, 0% rate of return. So assuming there is no rate of return, when this money depletes, which is this baby blue line here, that will probably take you to age 80, 88 or so. When that money depletes, your client gets a level payment. So if your client, knock on wood, passes away at 100, they will get that payment of FORLIFE, it'll be steady and stable. So forget the numbers, what the rate of return here is. The point of this slide is just to show that navy blue bar remains the same from the date that the purchase of this product to the death. That bar does not change. And this is very powerful, especially if you present it against a chart today. As we know, with heightened volatility, that can really gyrate. So I think this is a very powerful slide to mention. So as I mentioned, at this point, if the client passes away, what happens is a death benefit will trigger. So the point here is stable income is presented to your client in a very understandable and digestible way. 100% of deposits are made before age 80, get that 100% death benefit. Okay, so deposits after age 80 get 75. Guarantee at maturity is the same for all of our products, 75%. Sorry, my apologies, except for the 100, which is our 100% maturity guarantee. We have a maturity guarantee date of December 31st, that the year the annuitant turns 100. It's not impossible that, clients turn 100. I know Graeme just finished a cycling marathon or, long event in Italy, and he's in tip-top shape. So it is not impossible to hit that. So the maturity date, by the way, for our 100 is 15 years. And Graeme, you'll correct me if I'm wrong here. I think we're one of the only companies that still has maturity guarantee of 15 years. The payment cycle is super important for the FORLIFE. Very, very flexible. It could be monthly, it could be quarterly, it could be biannually, or it could be once a year. Very, very flexible payment structure. Now I'm going to get into the concepts. So I have about half an hour left. I'm going to get into the concepts. So RIFs, what is that minimum with withdrawal? What happened to the product if the minimum with withdrawal, as we know, at age 90 goes up by, up a pretty big amount to 20%? What happens there? Lifetime RIFs. This is the concept that I want to leave with you today. So minimum RIF withdrawals are respected with this product. If the market value at today's date is 182,000, that depletes. We know that the RIF minimum does go up as well. We will pay the RIF minimum at no reduction to future income in the FORLIFE product. So the FORLIFE product respects the minimum withdrawals for the RIF. That's a question I get almost every time I bring up this product with an advisor. That's really good to know, and that does not penalize you as well for chargeback or other series that you might be selecting for yourself. Here's the concept. So you do have, like I mentioned earlier, volatile investment products like mutual funds, ETFs, index funds, for example, and that chart kind of looks like that as of late. So your portfolio is going to go up and down. With this product, I am suggesting the bond fund, but we do have the equity version as well, which means you are kind of getting this at a lower scale, of course, but does it really matter? Because at the end of the day, we are giving you that guaranteed FORLIFE product. And if the market does bring up the investment, fantastic. That is a bigger death benefit for your beneficiaries. But the point here is you do have the benefit of investing in the market in less volatile options, but you do have that FORLIFE income that's guaranteed, that's creating a floor for your clients. And any benefits that happen in the stock market will benefit your death beneficiaries. Okay, sorry, your beneficiaries on the event of death. Now let's talk about the taxation. This is a big question I also get. So just to preface this, FORLIFE is no different than other seg funds. Okay, so FORLIFE is a seg fund. It is a seg fund contract, so you're getting all the benefits of seg funds, and it's taxed no differently. However, at the beginning, just like a life insurance policy, at the beginning, you are electing income, and that hasn't allowed for the product to grow and there to be a rate of return yet in the product. So you are getting a return of capital in the earlier years. In the later years, that's when you're going to get interest or dividends or whatever the case is, and that's going to be taxable to you at a capital gain. So the key here is if the market value is greater than zero, you will get a capital gain or a loss allocated to you, and that will be, depicted in a market value in an ACB, for example, and that will be, right when you log into ia.ca in your portal, you will see all of that outlined. And so the taxation of it is no different than seg funds. It's allocated to unit holders the way it is with pure seg funds. Same taxation benefits as pure seg funds. So yeah, and again with market value being zero. So in the event I showed the chart that, we've depleted the entire investment deposit at this point, at that moment on, you're going to get a capital gain, and it's not going to be an interest, which we know is what you get when you're invested in annuities, for example. So there is that tax benefit to investing in FORLIFE versus annuities. And that in and of itself is a simple sale if you can educate your client on the differences between being invested in annuities, which allocate as interest, or seg funds, which allocate as capital gains, like when you're selling it as a flexible annuity option. Okay, so just to get into a little bit more about the tax differences between mutual funds, to go one step further, our seg funds here, we have two kinds: the wrapped, so the ones that say Fidelity, Canadian Opportunities, or Dynamic, Global Dividend. Those funds are not pure seg funds. They're actually mutual funds, which we brought on and wrapped our seg fund wrapper on it. And, and we distribute it as a fund that we carry on our platform. However, we do have those seg funds, which, anyone here on this call that's been in a presentation with me, I do talk about the real estate income fund. That's actually the first presentation I've ever done here at IA. Love that fund. The Canadian Equity Growth Fund that we have, and the dividend fund. It's our dividend, Canadian dividend fund. And by the way, every single stock in that dividend fund pays a dividend, as opposed, I know it's kind of like, pretty obvious, but some companies, some of our competitors out there do have smaller cap or mid cap funds stocks that don't pay dividends in the fund. However, not with ours or Canadian dividend fund, all of the stocks pay dividends. So those funds, those IA funds, they are pure seg funds. And basically the way it works is we have a time of allocation. So if you've been invested in the seg fund in January, you are going to get an allocation for that time period. If you were invested in December, you're going to get an allocation at the end of the year for the month of December. Now, with mutual funds, here's where it gets tricky with IA funds too. If you have a Fidelity fund here and you're holding it only for the month of December, you're going to get the allocation in December 31st for the whole year. So that is the key difference between mutual funds and seg funds that are not pure seg funds. However, the FORLIFE is pure seg funds. So very simple tax method there. And of course, I had mentioned the benefits of the seg funds. You are getting a death benefit, you are getting a beneficiary designation, quicker probate, quicker settlement on death, possible protection against creditors as well. There are some differences in Quebec for any of those viewers here in Quebec. I think I did see my wholesaler in Quebec log on, Mark Holden. So he's your wholesaler, folks. So if you had any questions regarding IDC or how it relates specifically to Quebec, you can reach out to Mark Holden, who's currently on the call here as well, or I can connect you, whatever works. Our FORLIFE options at death. Here's a big, and I've harped on this before, and Graeme, you've highlighted it before. But we have a successor annuitant option that relates to FORLIFE as well. So we can recalculate the benefits, recalculate the income based on your spouse's age at the time of death. So, quick example, Mr. passes away, he has a younger spouse. That death benefit or that policy will recalculate, pay out the 100% death benefit to that surviving spouse, and Mrs. will get a recalculation based on her income and the benefits, and she'll receive the seg fund benefits based on her age. So that's a very big point, because we do chop up that policy based on the 100% death benefit if the market value is higher. And we're the only, correct me if I'm wrong, Graeme, I believe we're the only company that does allow for a top up on our successor annuitant designation. So very, very, even if whatever the case is, I would put it into practice that most of your policies should have a successor annuitant designation. I would definitely not skip that part. Now, to get into a little bit of a couple case studies here, I have 3. We have an illustration tool that's right on our on our website. It's under tools. That is the illustration tool. You will also see our current income rates posted weekly there as well. Okay, so we have a first very cookie cutter, very simple scenario. 65-year-old Dennis has $300,000, which is a prestige policy with IA, and he wants to invest in, a FORLIFE. At his age, he is getting 5%. This is just for illustration purposes. I'm pretty sure we're paying more than that, but this is just for illustration purposes. 5% is what he's getting at age 65. Oh, and by the way, guys, for anyone on this call who does do business with our competitors who sell GMWBs, the first place I always tell advisors to start with when they're looking at IA's product is go pop online, double check what the current rate is, then double check what it is that are at your competitors. And if it's better at the competitors, well, it's, maybe there's points that you want to have a discussion with myself or Fraser, your wholesaler, on why IA's product might be better or superior or inferior, as an example. But really, you want to do your own research and have a look at what those current income rates are before you look at the product details and any of that. So for this age 65, he's going to get 5%, and for FORLIFE income is guaranteed at $15,000. Very simple method of calculating it. Now, I have a second case where we're going to use a deferred annuity strategy. So we have the same thing between ages 65 and 67. Taking that 300,000 at 62, you're going to get 14,160. At 63, you're going to get 14,828, and so on. At 68, if you defer purchasing that income stream, but having, purchasing that income stream and taking it as opposed to reinvesting it, you will get an income of 18,916, which in percentage terms is 6.31% at age 68. So now let's look at this chart. At age 68, if you were to purchase it purchase this and take income at 68, you will be getting 5.24% as opposed to 6.31%. So the deferred annuity strategy really increases the annual income much more than you'd be able to get with the current income rate. So the mechanics of this product are as follows. IA on December 15th will take out the income from the policy and will reinvest it on your behalf. Okay, so that is an automatic thing that happens. The older you are, the higher you will get credited as an income rate. Okay, and instead of going into the saving stage at IA, we prefer the income stage and reinvesting it annually, because your point of it is guaranteeing income. And this is the only way that you can guarantee a higher income rate than the current income rate. Okay, now I want you to imagine this, because this is going to be my next case study. Imagine this strategy with the TFSA. I was just talking to Graeme earlier, and he had mentioned he has a GMWB product in his TFSA. So you're ahead of the game, Graeme, for doing that. But the point is tax-free income for life. So because, obviously the benefits of a TFSA, CRA does not allow annuities to be purchased in a TFSA. However, you can purchase the FORLIFE in a TFSA. So, going one step further than that, assets are protected in the event of legal action. The same is with seg funds. Any RRSP are exempt from seizure in the event of bankruptcy. But how about in the event of lawsuits, right? Having a beneficiary designation or having a seg fund contract can protect you in the event of a lawsuit as well. Okay, so very, very important part to highlight, especially with those business owners or professionals, doctors, lawyers, and so forth. So the third concept I wanted to point out is the TFSA concept, and I'm just trying to be mindful of time here at 15 minutes. Charles is age 65. He has $100,000 to invest from a transfer of his current TFSA. His TFSA has grown, so it's now $100,000. He wants to defer the FORLIFE income, doesn't need the money at 65, probably will need it at 70. He wants to invest his $6,000 annually into the TFSA, contributing into a FORLIFE product at IA. When he dies, he wants his wife, Julie, to receive the recalculated FORLIFE income, because as you know, at the age that he passes away, the policy will recalculate at the surviving spouse's age and mortality credit. Okay, so his wife will be 76 in this scenario when he passes away. So 100,000, the facts are above. At his age, he's going to get 5%. That's guaranteeing an income of $5,000 annually. Since he doesn't need the money, we're going to talk about reinvesting this strategy into the TFSA. I mentioned this chart earlier. I think this is a really good chart to highlight because all of the payments are being level. So if you're deferring this, you will actually receive, we had mentioned guaranteed income of $5,000. By deferring it, you will now receive $7,849,000. So this is directly on the illustration. For those that aren't familiar with it, this is on the illustration tool when you look it up online on Evo, on our website. So this is, I've just grabbed this from our tool. Here we have, and very similar to our competitors, by the way, who do have GMWB products, the same kind of format. So we have the year, the age, the deposit, so the initial deposit, the total deposits, and remember, we're reinvesting it. So from 100, we're taking that annual and reinvesting it into the policy. The rate of return here, I put 0. And then market value here, as you can see, this is the current market value. And it does gyrate just like, the stock market does. So the annual income, which is reinvested, there is that column. So your client can see today, at today's date, what the value is going to be 5 years from now. And at death, we have the death benefit value in the last column. So very, very straightforward. I also have here the highlighted. So this is the income that they're going to be guaranteed. And this is right on the application tool. So I had mentioned, let's do, the same scenario again. If he increases if he defers the annuity, the withdrawal increases. So the guaranteed income will be at 6.33%. So now if we go back, I hope I don't confuse you here, but if we go back to the female, if we go back to what the timetable is for females, what the current rate is, we know that you don't get 6.33 until maybe, mid-80s, right? So looking at female at 75 years old, you're getting 5.62, right? So what Charles did, guaranteed a higher income rate for his surviving spouse at 6.33, just by deferring the income in his TFSA. Okay, guys, so the concept I hope sticks. Maybe, the details are a bit foggy, but I hope this concept kind of sticks, and the point that we can put a TFSA, we can put a FORLIFE product into a TFSA. So here's just going through the overview. Now I'm going to get into, of course, and also I wanted to point out the smart TFSA strategy. So if you have contribution room and a spouse is potentially, at the end of their life, not very healthy, that sort of thing. What you could do is get a loan, for example, maximize that contribution room. So upon passing that contribution room with the RC240 is moved over to the surviving spouse. So that is the smart TFSA strategy. Okay, so just to kind of speed through here, I have about 10 minutes. Yep, I already talked about what the stipulations are. We need a minimum of $25,000 deposit. Compensation. So the part that you're probably all going to perk up and listen to. So please know that in the income stage, there is a difference in compensation versus a traditional seg fund. Okay, so DSC is 3% versus a traditional seg fund here at IA. We'll pay you 5.6%. Chargeback 3, it'll pay you 2%. Chargeback 5 will pay you 3%, and FEL is the same. So I wanted to point that out. The trailers are also impacted on the income stage. And there's simple reasons for that. At certain companies, I can only cite RBC because I used to work there. Their bonds pay less commission than, say, their equities. It's just a function of the product. The product is more stable and doesn't have that much yield to begin with. So, as such, the MERs are lower and we're not able to get you that higher, commission. But just know when you are transitioning from a saving stage to an income stage, we are paying you a 1% commission on that transition. But if it is a brand new contract that's coming to IA, you are subject to the income stage commission rates, which are here, which, by the way, do pay more than a GIC. A GIC pays you 20 basis points at IA, which is actually higher than I heard some of our other competitors that sell GICs, so something to know. But the FORLIFE does pay you more than that. So look at the solution before looking at a GIC, unless your clients are gung-ho on the product, especially right now it's in vogue. But definitely do look at this product, please. Do not overlook it. And then I talked about the 1% commission. And so, the traditional seg fund seg fund benefits apply here. You get the 100% death benefit. I'd mentioned creditor protection. So that leaves me at the end of my presentation. I have about 10 minutes. I do see the Q&A popping up here, but Graeme, on that note, I want to thank everyone for their time today and their attention. This could have been a really dense presentation, so I apologize in advance. But yeah, Graeme, over to you.
So first of all, thank you. That was really quite in depth. There was a lot of stuff there that was covered. A lot of good stuff, actually. Probably enough stuff for maybe even 2 presentations, quite frankly. But given the size of the audience here, I'm sure there'll be some follow-up calls and maybe some individual appointments to go over things in more detail. Definitely a solution that can go up against the other 2 with no problem. And I encourage people to obviously engage yourself and the rest of the IA team across the country to make sure they get into the weeds of the product and see where it can fit. Specifically, I liked there was some really good visuals in there. I mean, when we're talking about this kind of product, it's very easy to get caught up in charts showing numbers, and clients don't like to see 8 or 9 rows of numbers side by side. It just confuses them, and I think puts people off rather than engaging them in the process. So maybe we can put a chart showing the sequence of returns and what's actually going to happen to money should certain things happen. I think that's the kind of thing that people need to see visually if we're going to take them towards that guaranteed solution. What else is right in here? Obviously, the compensation for moving from one to the other. I know there's many products out there that when you're dealing with this audience, there's no compensation involved in changing from certain aspects. We deserve to get paid for the work we do. That's all I'll say to that. So that's a highlight. Internal funds you mentioned. Quite often we look to third-party names as being the solution that everybody should have. But you mentioned some stuff on the internal side there that's doing the right things. It's pure. That's from a taxation point of view. Obviously, the purity of that for ease for clients over the year is excellent. A lot of stuff. I took tons of notes there actually. So I do hope that others were taking the same kind of notes, and we'll have the questions for you. So I think we've got about 5 minutes left. Is there anything specific you want to address in the question and answer?
I'm trying to go through it here. So let's see here. Scenario 3 contributed 124,000, but the death benefit is only 76. The death benefit is proportionally decreased at each withdrawal if it's not a RIF. So that's something to know. So that's why there's that difference. But you do have that top up as well if the market value is much higher. So there is that differential there. For reduction of guarantees for redemption, are they done dollar? Yeah. Oh, so that answers that other question. It is proportional here. Are there dollar for dollar companies doing dollar for dollar still?
Well, I'm not sure about that actually, because one of the last contracts I think had the dollar for dollar was the Standard Life contract that was inside Pensionize offering, and we know obviously that's changing right now. So maybe in Sun's, that's something we need to confirm, but maybe in Sun Life's offering as well they had that we can confirm. Yeah,
that's a good one. Yeah, and I know this is income, but for the folks on the call, we do have excellent 100/100 products here. So with great funds like BlackRock and, other funds if your client's looking for that 100/100. So just wanted to point that out. Rate changes quickly. What happens if you transfer money from another institution? It takes a couple of weeks. Unfortunately, it's at the time. We don't have a rate guarantee for the FORLIFE. So if that transfer takes 6 weeks and the rates have gone down or have gone up, that benefits you. But one of the questions here says, what if the transfer takes some time? Unfortunately, they're going to get the rate as of that time. We don't have a guaranteed interest rate for the FORLIFE product. We only have it for the GICs. And then, yeah, that's about it that I have for open questions.
Okay.
Yeah.
Well, I mean, I think just to wrap things up, I think, you know, the premise of doing this was to show or illustrate what is available out there for guaranteed income. You know, as people are getting bad news thrown at them every single day. We're having portfolio managers, we're seeing investment advisors that have never had a down year basically in the last decade or so. So we're back to volatility, what an actual market means, and unfortunately around that there can be a lot of negativity. I look at it as being an opportunity. This is the market's on sale, and I mean any other business in the world when things are on sale, people flock to buy from them. Our world is the only world that when you know increased prices, people run to us. So you know the markets are on sale, products on sale. If clients do have extra assets that they can allocate, then it's a fantastic time to get in. I mean, no, it's not short-term money, that's longer-term money. But this type of product, if we've got a longer time frame, it's certainly going to work. And if people have an immediate need, as you've illustrated, they can get some decent rates of return right now, and guaranteed forever. You can't ask much more than that. It satisfies the emotional aspect of the way people are feeling. The typical person that buys this at an income stage is not somebody that wants volatility. They need to know that they can cover their expenses in retirement. They can stay in the house that they've always lived in, etc. Have the standard of living, have the annual vacation they like to look forward to, that kind of stuff. So that's what we're actually satisfying by using this type of product. We're not talking about performance. We're talking about guaranteeing somebody's lifestyle, letting them sleep at night, and keeping them in the house they've had for as long as they can. So thank you. Thanks to the team. Thanks for stepping up and doing this for us. It's always appreciated. You do a great job. And we look forward to the feedback and you know, the questions from maybe the audience members that didn't want to put it out right now. So thanks again.
Thanks very much for the opportunity. Okay, bye. Bye, everyone.
Bye.